Well, hello. This is our third in our series of webinars on prohibited transactions for our Set of Safeguard program. This session is on who is a disqualified person. And on March 17th, we discussed which transactions or what types of transactions are actually prohibited under the Section 4975 of the Code, our key provision. And we talked about what are the consequences. Then on April 28th, we talked about what a plan asset was and why that was important, because transactions involve plan assets. And then finally today we're talking about who is a disqualified person, because prohibited transactions involve plan assets and disqualified persons. So just to review, in order to be a prohibited transaction, the transaction has to be one of 6 types of different transactions, and it can be done either directly or indirectly. There's no real definition in the code of what indirectly means, so that's a gray area that is being fleshed out in a lot of case law. And second, it has to involve property of a plan. In other words, that's a plan asset. The plan could be the IRA, it could be a SLOK, or any one of a number of different types of retirement accounts or retirement plans. And the transaction has to be between the plan, in other words, the IRA, the SLOK, and a disqualified person. So what does that mean? What's a disqualified person? Let's talk about some important definitions. First is, what's a plan? That's any retirement plan. That includes IRAs, Roth IRAs, SLOKs, and all self-directed retirement accounts, which we call SDRAs. Then plan assets are, of course, any assets that are owned by a plan. So if your self-directed retirement account owns an asset, that's a plan asset. Any transaction involving that could be a prohibited transaction. And then finally, let's talk about what a fiduciary is, because a fiduciary is the key person having a role in prohibited transactions. The fiduciary is anybody who has a discretionary authority or control, or who manages plan assets, or provides investment advice, or manages or administers the plan. So for example, if your retirement account is with a registered investment advisor and they're managing the asset for you, then they could be a fiduciary, but if you're managing the plan asset yourself, then they're probably not. If they're providing investment advice to your IRA, then they can be a fiduciary of it as well. So there's lots of different ways for people to be a fiduciary, but the key one is that if you're the owner of a self-directed retirement account, you have discretionary authority or control over its assets, so you are a fiduciary and you're managing the plan assets. So all self-directed retirement account owners are fiduciaries. So finally, what is a disqualified person? Well, that's any fiduciary. So all fiduciaries are disqualified persons from the get-go. And then, of course, there's family members of a fiduciary. And that includes ancestors like parents and grandparents. It includes your spouse, if you're the fiduciary. It includes your lineal descendants, your children, your grandchildren, etc., and the spouses of your lineal descendants, but not your siblings. There's no real clear reason why siblings are not included among the people who are family members. I suspect it's because they are people who you do not have an obligation to support. So siblings are not disqualified persons just because they are related to you. They can become a disqualified person in another way if they become a fiduciary of your plan, but not by virtue of being your siblings. Then there are things that we call 50% net entities. That's my term. It's not a statutory term. So there's really 3 types. There's corporations that are owned directly or indirectly, 50% or more, by a plan fiduciary. All right. So if you own 50% or more of an entity, and if you have the voting power or the value of all the classes of stock, then that corporation will be a disqualified person with respect to your retirement account. Also, partnerships, of which 50% or more of the capital interests or profits are owned directly or indirectly by a plan fiduciary. So if you own 50% or more of a partnership, then the partnership itself is a disqualified person with respect to your retirement account. And then finally, trusts, 50% or more for the benefit of a plan fiduciary. So if there is a trust that you're a 50% beneficiary of, then that trust is a disqualified person with respect to your retirement account. And then there's officers and directors of those 50% entities. So if there is, for example, an LLC that you own 50% of, and there are officers who have management authority or control over that, they are also disqualified persons with respect to your account. And then if you have an entity and there are 10% or more shareholders, then those shareholders, by virtue of being 10% or more shareholders or partners of you as a disqualified person, or of the entity that you own 50% of, then they too are disqualified persons. So you have to own 50% of the entity, and if you do, then your partners that own 10% or more, or your other shareholders that own 10% or more, are also disqualified persons with respect to your retirement account. And then finally, there's highly compensated employees of 50% entities. So if you own an entity or own a company that you own 50% more of, and there are highly compensated employees in your company, and that's defined as someone who earns 10% or more of the yearly wages of the employer, meaning the entity, then they too are disqualified persons with respect to your retirement account. So if you own a business and you have highly compensated employees, then they can be disqualified persons with respect to your retirement accounts. So what do we mean by indirect ownership? So remember that the ownership of the 50% entity can be direct or indirect. All right. So what if an entity is owned 50% or more by a corporation I own? Well, that's the constructive ownership rule, or one of them, also known as attribution rules. So if you own 50% of an entity, and that entity owns 50% or more of another entity, then the second entity is a disqualified person with respect to your plan, because your ownership of that entity, 50% or more, is considered attributed to you, to the other entity. So an entity can be considered to be owned by you when it's owned by another person or entity that has a specific kind of relationship with you. And if so, the entity will be a disqualified person with respect to your self-directed retirement account. So let's have some examples. So first, let's say that you own 50% or more of a company, Company A, and Company A owns 50% or more of Company B. In that case, Company B is a disqualified person with respect to your retirement account. Clear and simple. So let's say that your son or daughter owns 50% or more of an LLC. Well, because of certain provisions in the code, the LLC is also a disqualified person with respect to your self-directed retirement account. That's the 50% rule. And then let's say that we have John and Jen, all right, and they're siblings, and they have retirement accounts, each of them. And let's say that their parents created a trust for their benefit, and they are the sole current beneficiaries of that trust. So they each own 50% or more. They each own 50% of the beneficial interests in the trust. In that case, the trust is also a disqualified person with respect to both John's self-directed retirement account and Jen's self-directed retirement account, because it's a trust 50% or more for the benefit of a fiduciary. John in John's case, Jen in Jen's case. So here's another one. So let's say that John is the self-directed retirement account owner, and Joe is his partner. And in our case, John owns 60% of Partnership A, and Joe owns 40% of Partnership A. Of course, that means that Partnership A is a disqualified person with respect to the SDRA account of John. Now, let's suppose that John owns 40% of a corporation, Corporation B, and Joe owns 60% of B. So the question then is B a disqualified person with respect to John's self-directed retirement account? And the answer is yes. Why? Because Joe is a 10% or more shareholder of Partnership A. So because Joe is a disqualified person, he owns 50% or more of Corporation B because he owns 60% of it. So B is a disqualified person with respect to John's self-directed retirement account. So here's another one. Let's say that in the prior example, Joe's wife owns 60% of company C. In that case, because Joe's wife is not a 10% shareholder in company A, in which Joe and John were 50% owners, or in which John was a 60% owner and Joe was a 40% owner, because Joe's wife is not an owner of a company 10% or more that John owns, Joe's wife is not a disqualified person. So since she owns 60% of company C is not a disqualified person with respect to John's self-directed retirement account. And then we have the Swanson case. This is really the first big case that affected self-directed retirement accounts. Here's what it says. It says that a corporation that has no owners can't be a disqualified person. So here are the facts of the case. Mr. Swanson established a corporation that had no shareholders. He was the president, treasurer, clerk, and sole director of the corporation. Mr. Swanson also had a corporation that he owned more than 50% of that was doing export sales. And he was paying a lot of commissions to companies that did that kind of work. So he decided that he was going to create his own export sales company so that he could take advantage of those commissions. So he established this corporation, and he was the president, treasurer, and clerk, and the sole director. And what he did was he had his retirement account purchase 100% of the shares of the corporation. So the IRS didn't like the fact that Mr. Swanson was the president, treasurer, and clerk, and sole director of the corporation, and felt that therefore the corporation was a disqualified person with respect to his retirement account. So the purchase of the shares by his retirement account was a prohibited transaction. Mr. Swanson disagreed, and so did the tax court. The tax court disagreed so strongly that they gave Mr. Swanson his attorney's fees. They awarded Mr. Swanson his attorney's fees against IRS for that part of the case. So the case holds that a corporation that has no owners can't be a disqualified person. But then what they did was they had a footnote. Some bright clerk said, well, we should clarify this in a footnote. So the footnote says, an IRA is a trust more than 50% for the benefit of its owner. Think about that. So your retirement account, your custodial retirement account, your IRA, is for the Swanson court says, it's a trust. And since you're the only beneficiary of the IRA, it's a trust 50% or more for your benefit as the owner. And since you are a fiduciary of your IRA, then when your IRA purchases the shares, 100% of the shares of the corporation, then the corporation is now owned by a trust more than 50% for the benefit of a fiduciary. So that means that the corporation is a disqualified person with respect to the IRA that owns it. Think about that. The IRA owns 100% of the corporation, and that makes the corporation a disqualified person with respect to the IRA. Now that doesn't really make any sense. It sounds a little silly, but that's what the Swanson court footnote says. Fortunately, the footnote is not part of the holding of the case, so it's not binding precedent with respect to that issue. The only thing that it's a binding precedent with respect to is the fact that a company that has no shareholders can't be a disqualified person, and that's an important principle. But this footnote has caused a lot of troubling effects. So let's say that the IRA owns 50% or more of an entity. Can additional contributions of capital to that entity be made? Well, the Swanson case suggests that no, the answer is no, you can't, because that is, since the entity is a disqualified person, then transferring more capital to the entity is a prohibited transaction because it's an exchange of plan assets between a plan and a disqualified person. And there's the site under section 4975 for that particular prohibited transaction. So that means that the IRA, if the IRA owns 50% or more of the entity under the Swanson case, then the IRA can't make additional contributions of capital to the entity that it owns. So, but what about this? Let's say that the entity makes profits. Can the entity now distribute the profits to the IRA that owns it? Well, the Swanson case implications suggest that no, it can't distribute the earnings to the IRA that it owns. Of course, that's an absurd result. So the Swanson case is really the source of something else that's an important concept in self-directed retirement accounts. And that is, since a corporation has no owners, when a corporation has no owners, it can't be a disqualified person, then that's the basis for what we call simultaneous funding. So what is simultaneous funding? Let's say that we have Phil. He wants to create an LLC that's going to buy a house. So, and he wants to own it 50% himself and 50% with his IRA. So simultaneous funding means that Phil and his IRA put their money in simultaneously. And that's based on the concept that the LLC, since the LLC has no owners before either one of them puts their money in, then the LLC can't be a disqualified person when the IRA puts its money in. And if Phil is doing it at the same time, then that's simultaneous. At that moment, the LLC can't be a disqualified person with respect to the retirement account. Now, of course, that is not the holding of the Swanson case. The Swanson case just says that until the LLC has an owner, it can't be a disqualified person. So what does simultaneous funding mean? Well, typically what that means is that we put the money in from the retirement account and the retirement account's owner, if we're going to do co-investing, on the same day. So now let's just retrace our logic for the Swanson footnotes. Remember that the logic was that an IRA is a trust more than 50% for the benefit of its owner. But if you think about what an IRA is, it's actually not a trust. A trust has two primary qualifications. The first is that it has a trustee that has independent powers with respect to the assets that the trustee holds for the benefit of the beneficiary. And the second is that the beneficiary doesn't control what the trustee can do. But in an IRA, the custodian of your self-directed retirement account holds the assets but has no authority and no discretionary authority over how they are invested. The only person that has the discretionary authority over how your IRA assets are invested is you. So in this case, it's a situation where the beneficiary is in control of what we are calling a trust. Well, so in fact, in law, an IRA is not actually a trust legally. So actually, the section that authorizes custodial accounts for IRAs actually says that a custodial IRA is not a trust. And here's where it is. It's section 408H. And this is the subsection of section 408 that authorizes IRAs and a bunch of different types that says that in section 408A, it says that a trust can be that's an IRA can be tax exempt if it satisfies certain requirements. And of course, a trust has trustees. But section 408H was established because the custodians of IRAs don't want to be trustees of the IRAs. They just want to be like a bank. They want to hold the assets. They want to offer you investments if they have them available, make money off of the investments that they sell you, but they want you to be in control. So section 408H basically says that if an IRA is held by a custodian, and that can be either a bank or some other person who's demonstrated that they're qualified to IRS, then the custodial account will also qualify under Section 408 as an IRA. And here's the key phrase. It says, and if the custodial account, it qualifies if the custodial account would, except for the fact that it's not a trust, constitute an individual retirement account described in subsection A. So even the code itself is saying that a custodial IRA is not a trust. But the custodial IRA has all the provisions that qualify it under Section A of Section 408, except for the fact that it's not a trust. So here we are, your custodial accounts at a bank or other custodian is not a trust, even under the code provisions. Now that it's going to be considered a trust for purposes of qualifying for the tax-free treatment, but there's nowhere in Section 408 or the particular chapter that it's in that says that the treatment of the IRA as a trust is also applicable for Section 4975 purposes, in other words, prohibited transaction purposes. So there's our concern about the Swanson footnote. The tax court thought at that time that the IRA should be treated as a trust, but of course you get some pretty absurd results when that means that the entity that the IRA owns 50% or more of is a disqualified person, so the IRA can't make more investment and can't even get its own profits back for that from that. That's a kind of absurd result. So that's an issue that continues to plague us and hasn't really been resolved. And remember, the tax court is really only a lower level court. If you get to the U.S. District Court or you get to the appellate courts, those are actually higher courts of authority. But a lot of the tax court cases don't get there and don't get overruled and don't get argued by lawyers who are before judges. So the judges of the tax court are basically tax specialists, and oftentimes they're not particularly savvy with respect to certain other business types of activity. Now, the Labor Department has a completely different view of this whole issue, and it says that a qualified plan that invests additional money into an entity of which it owns 50% or more is not committing a prohibited transaction. So it's okay to invest more money into an entity it owns. And this actually comes from a Labor Department case. And the case was one where I'll show you this one. Mellon Bank was being the trustee for a group of employee plans for Verizon. And Mellon Bank wanted to invest the funds that were in those plans into a mutual fund, a large fund that had a lot of different types of investments in it. And it established this fund with a couple of entities. But Mellon was going to own more than 50% of this entity, and it's called CIV. So Mellon was going to end up owning 50% or more of the interests in this fund. But it would hold the interests on behalf of the Verizon plans, not on behalf of itself or on behalf of a third party. So the reason that the Department of Labor said that that Mellon, as a trustee of the plan, when it invested in the CIV, if it owned 50% or more of the CIV, it was investing on behalf of the plans, and it wasn't investing on behalf of itself. So that was perfectly okay. So that is a position that really is directly contrary to what the tax court has said, and it still remains unresolved today. So here's how I summarize the Swanson case. The Swanson case stands for the proposition that there's a simultaneous investment theory. Of course, that's not the holding of the case, but I call that SIT or SIT for short. The Swanson footnote is the basis of the no follow-on investment theory. In other words, once you've made the investment and you own 50% or more if you're the IRA, you can't invest more into the entity, so there's no follow-on investment into the entity. The Department of Labor says that follow-on investment is okay, even if you own 50% or more of the entity. So Pensco, which is the custodian for most of our self-directed retirement account clients, has this awkward position, and they're sort of caught between the rock and a hard place. What they're saying is that FIT, or follow-on investment, is okay with entities that are owned 100% by self-directed retirement account. And they're basing that on the Mellon case that I talked to you about. But Mellon didn't actually own 100% of that CIV. But FIT is not, follow-on investment is not okay with entities where the IRA owns 50% or more, but less than 100%. So, Pensco thinks that that's a pretty awkward position too, and we've talked about that. But they're sort of in between the rock and the hard place. That's as far as the cases and the regulations have developed. And then last year there was the Ellis case. Now Ellis is significant from the point of view of constructive ownership and the funding issue because it makes a major difference, and this is a tax court case, it makes a major difference on whether we can do follow-on investment. So here's what Ellis did. Ellis had an IRA that he established because he was rolling money over from his 401k. And his plan was that his IRA would be a member of his new LLC holding 98% of the entity's interests. And an unrelated third party was going to hold 2%. Now, if you remember the plan asset rules, you'll realize that what he was apparently trying to do was to qualify this LLC as an operating company. In other words, if his IRA owned 100%, it wouldn't be able to be called an operating company, but since there was an unrelated third party owning 2%, then theoretically that made it an operating company. And the reason that was important to him was because he was going to be the manager of the LLC. The LLC was going to own and operate a used car business, and so he was planning to actually pay himself. So he established this entity, and this is the ownership percentages that he established. So under the operating agreement, his IRA was committed to buying 98% of all of the units, and in this case it was 980,000 units. And they was going to buy that for $319,500. The IRA purchased, but the problem was that his IRA got the $319,500 from his 401k in two different installments. The first one was for $254,000, and the second one was something like $65,700. So that money got transferred over to his IRA, and then he instructed his custodian to purchase these units. But even though the operating agreement said that the IRA was going to own 98% and purchase 980,000 units, it actually purchased 779,141 units for $254,000 on June 23rd, 2005, and then later on August 25th, 2005, it purchased another $65,500 worth, or 200,859 units. So here we have an entity that is 50% or more owned by the retirement account, and it makes an additional investment after the initial installment. So what did the tax court say about that? Well, the tax court said that was okay. No prohibited transaction. Why? Well, the reason was that the operating agreement committed the retirement account to purchasing the full amount for the $300,000, and although the money came in at different installments, the IRA was actually committed by contract to purchase the whole $319,500. So just because it came in two different tranches or two different installments, as far as the tax court was concerned, it was all the same investment. So what does that mean? Well, the implication is that follow-on investment only applies when you have an entity where you've made an initial commitment and fulfilled it, and then you want to put more money in after that. The fundamental distinction here apparently is that the LLC operating agreement committed the IRA to a certain amount of money, and that was fine because it had a contractual obligation. My question then is, well, okay, suppose we want to add more money later, we just modify the LLC agreement, and then off we go. So again, this whole follow-on investment issue gets a little bit absurd because, again, we can modify the agreement later so that the commitment is greater, but it does suggest that although we can make the initial investment and we can have our initial obligation under the agreement, the IRA that owns 50% or more of the entity can't be subject to a call for additional capital. All right, so here's our summary. The way I would summarize this is that, the easy part of this is that if you're a fiduciary of your retirement account, you're the owner of the retirement account, you are a fiduciary, then you are a disqualified person with respect to your retirement account, and then there are people that are related to you, such as your family, 50% entities, your 10% or more partners, and highly compensated employees of your entities. All of those are disqualified persons. Fairly simple. Then we get to the Swanson case and the Swanson case footnotes, and things get a little bit more absurd because of the whole issue of whether an IRA is a trust. All of those issues go away. If we assume that an IRA is not a trust, it can own 50% or more of an entity, and if it's not a trust, the entity is not owned by a trust. So that rule about a trust for the benefit of 50% or more by a disqualified person wouldn't apply. So this is an issue for further development by the cases. So what I'd like to do is I'd like to summarize this and the last three sessions by giving you what I call my top 10 mistakes. So let's say that we're going to buy a house, excuse me, with the self-directed retirement account for cash. Here's Phil, and the first mistake is pulling the trigger too soon. So here's the house. Phil decides he goes to see the broker and he signs a purchase and sale agreement. Here's the seller, and he signs a purchase and sale agreement with the seller to buy the house himself. And then he takes his money, he puts the money into and deposits it with the broker. Then he decides he's going to use his retirement account to actually purchase the property. So he funds his retirement account with a self-directed retirement account with cash, and then he takes the cash and pays the seller, and then the broker's money goes and pays the seller too. Well, what has actually happened here is that Phil has made an excess contribution to his retirement account because that money isn't retirement account money that went into the purchase of the house. So let's say he made a deposit of 10% on the house. 10% of the purchase proceeds were his own money. His retirement account only purchased 90% of the property, but it got 100% of the property by deed. So actually, Phil has made an excess contribution to his retirement account because he pulled the trigger too soon. He bought the house before he had his IRA set up to actually make that deposit with the broker and sign the purchase and sale agreement. So how could we resolve that? Well, let's say that Phil has set up his retirement account and he's all ready to make the deposit. He signs the purchase and sale agreement. His retirement account signs the purchase and sale agreement with the seller and voids the old agreement. And this can actually happen at the closing when he pulls the trigger too soon. So in this case, the self-directed retirement account pays 100% of the purchase price at the time of the closing, and the broker gives Phil the money back. All right, so those broker proceeds never actually got mingled with the self-directed retirement account's cash, and the seller only got money from the retirement account. So the retirement account actually paid 100% of the purchase. So he hasn't, although maybe he has pulled the trigger too soon, but he gets over that problem because he can have, if he gets a new purchase and sale agreement, all signed at the closing, and all the money comes from his retirement account, and the broker's fee comes from the seller, and that's being illustrated here. In other words, the seller actually pays the broker directly, but not from Phil's deposit. Now Phil hasn't pulled the trigger too soon, he doesn't have that problem, and he hasn't made an excess contribution. So next problem is managing the property. So Phil now has this property. His self-directed retirement account custodian doesn't want to manage the property for him, so somebody has to take care of that. Well, that's Phil. So what can Phil do? Can he decide on lease terms to the tenants? Can he prepare the lease document? Can he receive the rent checks? Can he send the checks to the custodian? Can he collect the rents if the tenant doesn't pay? Can he sweep the floors? Can he fix the toilets? Well, here are some clear answers to those. He cannot provide non-fiduciary services. And what we mean by that is there's something called settlor functions, meaning that the functions that a fiduciary performs because they are managing or maintaining a plan so that it will operate correctly. And those are services that a fiduciary performs. But if Phil performs other services, we're calling those non-fiduciary services for this purpose, then there could be a problem. So in this case, he can decide the lease terms because that's basically deciding how his retirement account money is being invested in the lease. So he can decide the lease terms that are going to be offered to the tenant, but he can't really prepare the lease because that's not typically what a trustee of a trust or fiduciary would do. He can receive the checks because, again, that's something that's necessary for the operation of the plan, and he can send the checks to the custodian, but he can't really go out and collect the rents like a collection agent would do. He can't sweep the floor and he can't fix the toilets. So what if he hires a manager? Here's the solution to that. So he hires a property manager to take care of all of those other things, preparing the lease documents, collecting the rent, sweeping the floors, and fixing the toilets. And in that case, he doesn't have that problem. So now the next problem is what I call the undercapitalization problem. And in this case, we've got his property is held by his retirement account, but there's been a big storm and there's damage to the property. So what can Phil do? Can he pay expenses from his non-self-directed retirement account funds? In other words, let's say his retirement account doesn't have any more money in it. Can he pay the expenses from his non-retirement account funds? Can he? Well, the answer to that is no, of course, because he would be mingling funds and benefiting his retirement account with his own money. That would be an excess contribution. Can he guarantee a loan from the bank? Let's say he wants to go out to a bank, he wants to borrow money to fix the place up. The bank's going to say, well, Phil, that's fine, we're glad to lend you the money as long as you guarantee it personally. Can he guarantee the loan? Well, unfortunately, the answer to that is no. Of course, one other solution is he could actually add more IRA funds to his self-directed retirement account by going to his existing custodian where he has cash or other liquid assets, transferring them over to his retirement account, and now his retirement account can actually put those funds into the into the property, because again, the property itself is owned by the retirement account, and it can certainly maintain its assets. So that's okay. Can he lend money to his self-directed retirement account on an emergency basis? Well, this is a kind of exception to the no loan rule. The Labor Department came out with some regulations that said that you can actually lend money to a retirement account on an emergency basis if it means that the retirement account is going to lose its investment. In other words, it's going to be some kind of a disaster. There has to be a promissory note, and there has to be the circumstances where there's a potential loss. So it seems like those Labor Department regulations would qualify here. The promissory note can have no interest, so theoretically he could lend that money and then be paid back subsequently by the retirement account. But that has to be in a written promissory note, and the terms have to be clear, and it has to be without interest. So that's questionably okay because the regulation is so new, there are really no cases on exactly what the circumstances are that the regulation applies to. So this is one of those things where we would probably go to the Labor Department and say, look, I've got this problem, can we do this? And they typically answer questions fairly quickly. So what about borrowing money from Phil's sister? Well, Phil can actually do that because Phil's sister is not a disqualified person with respect to his retirement account. So if she's got the money, she can lend it to his retirement account and fix the property up and then pay her back with subsequent installments, or maybe pay back in full if there's some kind of insurance receipt. So here's another issue dealing with disaster. Suppose we have a tenant. And the tenant has been through this disaster, and the tenant says that the property fell apart and that was at the negligence of Phil and his retirement account. So the tenant sues Phil and says, you owe me money, and it sues the retirement account and says, you owe me money. And so the tenant can actually end up taking the property. And of course, that's not really a great result for Phil because the tenant had Phil as a person who was liable. So the taking of the property by the tenant means that A, his retirement account is now worth nothing that held the property, but also it's possible that Phil could be said to have received income because the liability is may be considered to be Phil's in the lawsuit, and so the IRA is actually paying a liability of Phil's, and that would be a distribution. So Phil could end up with tax liability not on the loss to the tenant, as well as having an account that's worth nothing. So what can Phil do? Well, Phil has to instruct the custodian to buy liability insurance so that the tenant can get paid. Well, that may or may not be a sufficient amount to pay the tenant off, but that would be okay. But what we're really seeing here is that Phil owns the property. Phil's retirement account owns the property in the wrong way. It's got the next mistake is using the wrong holding entity. So let's say that in this case, instead of having the IRA own the property directly, it establishes an LLC. It owns 100% of the LLC. The lease is with the tenant. The property manager has negotiated the lease with the tenant and had them sign them. The tenant, there's a disaster. The tenant sues the LLC. Phil has no personal liability because that's the characteristic of the LLC. And the custodian, his retirement account, has no liability. So although the tenant can still take the house in judgment, Phil and his retirement account don't end up being liable, and the loss of the house doesn't end up being taxable to Phil. So that solves the wrong holding entity problem. So now let's say that let's talk about some capital conundrums. Let's say that Phil wants to buy the property, and he can afford to buy the property himself, but his retirement account doesn't have enough to purchase it, so he wants to cut his retirement account in 50-50. So Phil wants to own the property 50-50 with his retirement account. And this he's going to do with simultaneous funding, so both he and his retirement account put their money in at the same time and they purchase the property. Now we have a disaster. Where do we get money to pay for the maintenance of the property? Can the IRA add more capital? Well, this is a problem because 50% of the entity is owned by Phil, and he's a disqualified person with respect to the retirement account. So the LLC is a disqualified person. So the IRA can't put more money into the LLC. So essentially what the IRA has here is the wrong partner. That's the next of the top 10 mistakes. Can Phil add more capital? Well, that's possible because, again, Phil doesn't have any disqualified persons with respect to himself, so Phil could theoretically actually add more capital to the LLC. And so they can fix the property up using Phil's money. But remember, at the beginning of this hypothetical, we assumed that Phil could afford to buy the property himself, all right? But let's say that he can't, but he's got lots of money in his retirement account, but he wants to cut himself into some of the profits. So that's why that's his motivation for actually investing 50-50. Let's say his retirement account has plenty of money to purchase the whole property, but Phil can't afford to buy it himself, so he calls his retirement account in to help him. Well, that's the next problem. That's indirect personal benefit. In other words, because Phil can't afford to buy it, he's using the proceeds of his retirement account to purchase the property, and he's getting an indirect personal benefit so that he can cut himself into the investment. Now, this is one of those mistakes, or one of those top 10 mistakes, that is entirely dependent on the fact circumstances. So when a client asks me, can I invest 50-50 with my IRA? My next question is, well, could you buy the property entirely yourself? And if they had the resources to do that, then it's probably okay, and we're not going to have an indirect personal benefit. But if they don't, and they say, well, my IRA has plenty of money, but I want to buy the property and get some of the profits myself, and I want to use the IRA to leverage that, that would be an indirect personal benefit. So let's say that we have Phil has a brother, Paul. And so Phil wants to buy the property for his retirement account, but he wants to avoid all those problems that we've been talking about. So he persuades his brother, Paul, to co-invest with his retirement account. So Paul puts in 50% and they purchase the property. Can the IRA add more capital? Well, again, Paul is not a disqualified person with respect to the retirement account, so you would say that the LLC is not a disqualified person with respect to the retirement account. But wait, remember that the IRA could be considered a trust with respect to itself, and it's a trust more than 50% for the benefit of Phil. So under the Swanson case, in that footnote, the LLC can be considered a disqualified person with respect to Phil's IRA, and that's what I call the 50% trap. Again, even though you've got a co-investor that's 50% of the LLC that is not a disqualified person, the IRA still can't add more money in because the LLC can be considered a disqualified person. Now, again, I don't agree with that interpretation. I don't agree with the tax court. The tax court's subsequent holding suggests that it's beginning to get the idea that maybe that's not such a good idea. But again, we still have that whole issue, and so that's what's called the 50% trap. So the IRA, again, can't add more capital. So now let's say that Paul and Mary are going to co-invest with Phil's IRA. And Paul and Mary are, let's say, siblings, or at least they're not related to Paul. So we're going to call that the Phil, Paul, and Mary. I should have named Phil Peter, because it would be Peter, Paul, and Mary LLC. But anyway, so Phil's IRA is going to own 1/3, Paul owns 1/3, and Mary owns 1/3. So can PPM LLC borrow money to renovate the property? Or if they had the disaster, could they borrow money to fix it up? Well, so what we do is we go to the bank and we lend money. The bank lends money to PPM LLC, and off we go. And the bank says, no, we don't need a guarantee from Phil. So Phil is not providing a credit facility to his retirement account, and therefore that's not a prohibited transaction. The bank could say, okay, we need a guarantee from Paul or from Mary or from both. But again, the bank lends the money to PPM LLC, and off we go. And let's say that 60% of the purchase price here is loaned to PPM in order to purchase the property. Well, now here's a problem. Because the property this is Phil's IRA, and because the property is 60% financed, then 60% of Phil's profits from it are going to be subject to the unrelated business income tax. Remember, leveraged property is subject to the unrelated business income tax. So because 60% is loaned, then 60% of whatever income Phil's retirement account gets is going to be taxed under the unrelated business income tax. So what could we do with that? Well, we could say if Phil's IRA instead is a solo K, the unrelated business income tax for loans does not apply to 401ks, and so it's arguable, therefore, that the provision is not going, the unrelated business income tax isn't applicable to the solo K, and that's what many people operate under, so that they can have a solo K, and they don't have to worry about the unrelated business income tax for loans, and they can borrow money on their property and get the leverage of that. Can Phil guarantee the loan? No, of course he can't, because that would be creating a prohibited transaction. So, and then finally, can Phil be the manager? Well, okay, so we've got the custodian owns 1/3, the IRA owns 1/3, Paul owns 1/3, and Mary owns 1/3. So, and it's purchasing a piece of property, and if you remember the plan asset rules, under the plan asset rules, PPM now becomes an operating company. In fact, it's a real estate operating company. And it's not owned 50% or more by a disqualified person. The assets inside PPM are not IRA assets, and so one could argue, therefore, that Phil could be the manager, and one could argue that he could be paid. But remember, there's that one little catch to that, and that is the prior arrangement rule, which says that if Phil, Paul, and Mary established this entity in order to purchase the property with the expectation that Phil would be the manager and paid, then that would again be a prohibited transaction. So we call that failing to maintain compliance. So although we started off being compliant, there was nothing wrong with Phil being the manager. It's an operating company, and he can even be a fiduciary with respect to the plan assets inside if they're plan assets. But if he gets paid, and that's been anticipated at the time they set it up, then that is a prohibited transaction. It's arguable that if they start off with Paul being the manager, and Paul says a couple of years later, I don't want to do this anymore, Phil, would you please take it over, that is not a prior arrangement, and that possibly that Phil could be paid for that. But that's one of those gray areas, and in fact, the Ellis case suggests that we shouldn't be terribly reliant on the plan asset rules for the Labor Department, because in the Ellis case, it was theoretically an operating company that was owned 90%, 98% by his retirement account. But my suggestion is that case went off on the fact that it was done as a prior arrangement, so the plan asset rules didn't apply anyway. So in this case, Phil can't be paid if there's a prior arrangement for him to be the manager, and that's the final mistake that I call failing to maintain compliance. So in summary, if a transaction seems to be an indirect prohibited transaction, I would say it probably is. At least it means that you should ask the question. Don't forget about the prior arrangement rule when entering into agreements to decide how you're going to fund property, because if there is anticipation that you're going to actually get paid for something yourself, and that's done by a prior arrangement, then your plan asset rules aren't going to help. Remember that you should try to keep it simple, avoid those gray areas. Invest with unrelated parties. If you invest your retirement account in entities with unrelated parties, as I've shown in the example, a lot of those problems go away. The 50% rule goes away if there's 1/3, 1/3, 1/3. Having people manage the property that aren't a disqualified person, all of that goes away, and the investments are, none of those technical issues when you've got 50% or more owned by the IRA or disqualified person actually apply. Be aware that all income in an IRA is unrelated business taxable income unless it's exempt. And of course, for most retirement accounts investing in real estate, they're receiving rents, which is one exempt kind. They're receiving, if they're lending money, they're getting interest. That's another exempt type of income. If they're getting royalties, they're getting another type of exempt income. So for all of those retirement accounts, even though the income is unrelated business taxable income, it's exempt from the tax. And if debt financing is in order, be aware that there's going to be unrelated debt financing income, and you have to run the numbers. It's not necessarily so that unrelated debt financed income makes it impossible for you to make the investment. It just means that your retirement account is going to have to pay some amount of tax based on the amount of leverage. But if you run the numbers and see that the after-tax actual return that you're going to receive on the investment is still great, it's better than you can get somewhere else, there's no need to avoid doing the unrelated debt financed income tax. Remember that your SDRA's, the self-directed retirement account's single member LLC's assets are plan assets. That's the 100% rule. You know, if the LLC owns a piece of property, it could be an operating company, a real estate operating company. But if it's owned 100% by your retirement account, that's that 100% rule that says no, it can't be an operating company. And remember that you are a fiduciary. If you are making decisions about how your retirement account is being invested, that makes you a fiduciary. In all cases, as a retirement account owner and even with a solo K trustee, you are a fiduciary of the plan. That makes you a disqualified person in all cases. And so when you have a question about anything in these areas, please be sure to use your first call rights. Call us when you're considering any transaction involving your self-directed retirement account. So that's our class for today. Just one final thing. I want to I want everybody to note that we have a new website called, and that's over here under self-directed retirement account. It's called https://sdraservices.com. So if you just put into your browser sdraservices.com, you'll come to our website, and here's what it looks like. So as time goes by, we're going to be adding a lot of additional information to this. It describes what our services are. There's a blog, and it talks about the SDRA Safeguard strategy and how people should follow it. Many of our SDRA Safeguard members are involved with that. So again, thank you very much for attending. Look forward to hearing from you. Be sure to give us a call if you have any questions, and good investing and much success.